Hello, this is Emily Costa and welcome to the Commodities Institute podcast. Today is December 4th, 2025. I want to take you through a tightly woven hour of market moves and political undercurrents that turned up across oil, metals, agriculture and power this week. I'll keep things measured and conversational, and I'll connect the dots so you can hear not only what happened, but why it matters. Let's start with oil, because the numbers and the politics are telling a similar story. Last week, US crude and fuel stocks rose, even as refiners pushed runs higher. Crude inventories climbed by 574,000 barrels to about 427.5 million barrels in the week to November 28th, while refinery runs were increased as refining utilization moved above 94%. On the surface, builds like that weigh on prices, more supply, lower near-term pressure, but context is everything. Refiners ramped runs because margins improved, which means refined product flows will be available into the market even as seasonal gasoline demand fades. So expect continued pressure on refining margins even when refinery activity is high. More product chasing declining demand is a dynamic we've already seen in other cycles. The geopolitics, though, are what really deserve attention. A separate, bigger picture story unfolded in Iraq, where a flaring diplomatic contest over a key export pipeline illustrated how energy policy and foreign policy are now deeply entangled. Attacks in northern oil fields that halted production prompted an unusually forceful US push on Baghdad to reopen a pipeline to Turkey's Ceyhan port. The pipeline's restart in late September, after months of pressure, isn't just about restoring flows. It's emblematic of shifting influence inside Iraq. For traders and investors, the lesson is that infrastructure decisions that look local can have outsized global market impact. The pipeline swung supply routes and, in some cases, starved revenues that previously flowed through informal channels benefiting Iran and its proxies. That ripple affects price sentiment and the politics of supply security in the region. Switching gears to metals, Glencore's Investor Day sent a clear signal that miners are recalibrating growth plans. The company trimmed its guidance for next year, citing lower ore grades and water constraints at a major Chilean operation, and signaled a long-range target to ramp copper production toward 1.6 million metric tons by 2035 through a mix of new projects and restarts. There's a reality check here. The energy transition rhetoric keeps demand forecasts robust for copper, but supply-side constraints, permitting and the raw geology of ore bodies mean growth is rarely linear. Glencore's pivot toward organic expansion and the heavy capital plans for big projects like El Pachón in Argentina illustrate that the pathway to more copper is capital and time intensive. Markets should expect volatility as companies chase volumes while wrestling with operational hurdles. On carbon and power, Turkey's moves are worth watching. Ankara extended a one-year gas deal with Russia, while simultaneously hedging by signing long-term LNG purchase commitments, largely from the United States, and even talking about direct upstream investments there. That dual approach, securing existing pipeline ties while building out LNG flexibility, is becoming a template for countries that want to balance political relationships and energy security. For Europe, the conversation remains just as urgent. The EU's push to phase out Russian pipeline gas by 2027 is creating winners and losers across member states, and practical constraints, geography, port access, cost differentials versus LNG, mean this transition will be politically contested and operationally messy. Agriculture had two very different beats that illustrate how weather and disease risks interact with policy and markets. In France, sugar beet yields are bouncing back thanks to favourable weather, pushing projected output higher. But farmers are anxious. Weak EU sugar prices are hovering around multi-year lows, and growers want regulatory tools to limit downside during market slumps. Ideas like allowing selling into storage or triggering import suspensions tied to a floor price. That's a classic producer response. When markets fail to remunerate risk, producers look to policy as a backstop. Meanwhile, in Brazil, despite a bird flu scare earlier in the year that prompted some trade bans, chicken exports are forecast to edge up. Brazilian exporters avoided the worst of the restrictions from key buyers, and the global reappearance of avian influenza in other producers, notably in the United States, may actually open more export opportunities for Brazil. It's a reminder that in agriculture, supply shocks in one region can quickly reconfigure trade flows and price trajectories elsewhere. Back on shipping and freight, the Black Sea story is a reminder that security shocks can spike costs quickly. Recent attacks on Russia-linked tankers have raised insurance and routing costs and amplified the risk premium for certain trades. For dry freight and tanker operators, the immediacy of higher premiums and occasional rerouting is a direct cost that feeds into freight rates and downstream commodity prices. Geopolitical disruptions don't just move headline prices, they change the marginal cost of moving cargo, and that feeds into spreads and trade decisions. Before I wrap, let's tie a few loose threads together. Energy, metals, agriculture and freight are no longer separate lanes. They're an integrated market. A pipeline reopened for political leverage can alter crude flows and refining patterns. A miner pausing to rebalance around ore quality affects copper availability for electrification projects. A bird flu outbreak in one hemisphere can lift the export fortunes of another. And security incidents at sea add a non-trivial premium to the cost of moving goods. For listeners who trade, invest or advise in commodities, the key takeaway is this: watch political and physical infrastructure as closely as you watch inventories and earnings. They move markets in ways models struggle to capture. That's it for today. I appreciate you listening to the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.